What's happening right now is simply historic. If you're still here, if you're still alive in the crypto ecosystem, you've survived longer than some of the most prolific altcoin and Bitcoin traders in history. You've survived longer than some of the biggest DeFi founders, managing tens of billions of dollars at their peak. Even still being here is an accomplishment, because what we're about to show you will explain that the issues that are occurring here in the crypto ecosystem are by no means native to crypto, and that what's happening across all risk assets across the entire world is something of historic proportions. So let's go in and explain what's happening with the meltdown of the everything bubble, how it affects crypto, and what's going to happen next. As always, if you enjoy the content, please smash that like button, as we're going to be doing our best to bring you up-to-date information, helping you navigate this wild world of crypto and really all markets, as the issues that are facing crypto are facing all markets. And learning to play this game within crypto will actually let you play the game in many other markets as well. Anyone who's invested any money in any market needs to hear what we're about to say. So where are we right now? Because when we look to the charts, we see that Bitcoin is just pumping up here, up 5% on the day. And this is the second day in a row that it's actually having some nice green numbers. And that's because just a few days ago, we can see that Bitcoin dipped pretty significantly under its prior all-time high, going well under a number that we believed would be psychologically defended. You see, it's common knowledge that the prior peak of the prior cycle will ultimately never be reached on the following cycle's crash. Well, at least that's dogma in traditional markets, is that the prior peak becomes strong support for the next crash. Well, that's not at all what happened, because this crash is unlike any other crash before. You see, normally in a normal bear market that was just affecting crypto, we would expect Ethereum and Bitcoin to somewhat come down in the 80 to 90% region at its ultimate max pain. And usually that would only happen during a massive capitulation. However, what we're seeing is that the events of the last few weeks, coupled with the most insanely unreliable and untrustworthy macro investment climate, have led to an accelerated downside, which pushed Bitcoin and Ethereum far further down than anyone would have expected them to go under normal bear market conditions. So, in many ways, the rules of the game have been thrown out. However, in my opinion, we can start to estimate where the bottom might be based upon this new, faster trajectory down. Remember, DeFi has not just bent, it's broken. And while breaking and exposing the pain and suffering that leverage cascades can create, we've also identified some parts of crypto that absolutely must be fixed in order to create a sustainable, decentralized world of the future. So what has the bear market taught us so far? Well, first and foremost, crypto is by no means a non-correlated asset class. In fact, its correlation has reached record highs, with Bitcoin and Ethereum trading in lockstep with the NASDAQ and traditional investment markets. We've also seen Bitcoin completely fail to act as an investment hedge, down 70% with its price declines, so the store of value in digital gold narrative has taken a serious blow. Now, we all know that over a long enough period of time, Bitcoin continues to appreciate as it's deflationary by nature. However, in any kind of short stint, this is the type of event, these are the types of collapses that pretty much make no one want to save their money in Bitcoin. Thus, the actual flow and the usage as perceived by the general public is not one of a store of value, but actually a volatile and risky asset. But of course, this is not a normal crypto crash. If things were normal, the crash would have been in proportion to the gains. We know that the gains were about 3x over prior all-time high, so we could assume that because those diminished returns were in effect, that we would have gotten a less severe crash. However, as keepfishing.eth explains here, I cannot emphasize how true this is. Congrats on surviving a crypto crash, but it's a whole different beast from the whole system is falling apart and capitalism might be coming to an end. Those are different kinds of scars. This is, of course, in response to Jake's tweet here saying, if you had no assets in 2008, please don't sell me your gained experience off the crypto crash of 2017. Effectively, the point here is that whatever happened in 2017 should not be used as meaningful experience to really embark on this insane everything bubble collapse that we're seeing take place across all mainstream markets, housing markets. Pretty much every financial market is in the gutter right now, which is in many ways unprecedented. Now, the reality is that all markets have bounces. All markets go back and forth. However, in crypto, what we've seen is pretty much not a single convincing relief rally. So how did this happen? How did the market tank so aggressively that literally all you had to do was hold on to a short since November with no convincing bear market rallies to make you think, you know what, the worst is in, and maybe it's time for some upward trajectory in the markets? No, it's just been crash after crash after crash. So understanding what caused this relentless selling will help us identify the parts of cryptocurrency that need to grow and mature for the next cycle to be more reliable, for consumer trust to be reinstilled in this wild new world. It's important to understand that there is a house of cards that's been built on greed and leverage. Well, there are a few explanations for this. First, there is a historic macro storm. We've definitely seen this. We have negative GDP growth, bear market, inflation, 130% debt to GDP, and rate hikes. None of us have ever witnessed this. Again, it's one thing to say, hey, could I have played the game better? It's another thing when, hey, the rules of the game, the actual field you're playing on, the referees and the other team are all changing rapidly as you're trying to play the game. It really changes the lens in which you need to view your own performance. As you can see from this chart, there hasn't been a meaningful stock market crash in quite some time. As you can see in this chart, there have been several major stock market crashes over history. And as you can see, it looks as though, based on this, just eyeballing it, that we are due for another one. And that's certainly what it seems like is happening right now. But what I really want to draw attention to here is this second reason why we're crashing, because this to me explains the dramatic underperformance of crypto over the last few weeks. Because what's been happening is that big institutions such as Luna, such as Celsius, such as 3AC, have ended up as forced sellers with different liquidation cascades. We all know how Luna UST blew up. That's its own video. I made a whole video on that. Feel free to check it out. But now we're seeing contagion risks where we're seeing Celsius go down. We're seeing Three Arrows Capital go down. And that's because of hidden leverage in the system. Let's go deeper. While everyone was cheering for institutional adoption of crypto in 2020, the large influx of traditional investors now comes home to roost, because with crypto being perceived as the riskiest asset class, BTC, ETH, and Co. are the first assets to be liquidated from institutional books. Stocks crashed 10%. Now funds have to sell other assets to cover margin calls and reduce portfolio risk. This is a self-perpetuating mechanism that has led to relentless selling in the past few weeks. The institutions are here, and they're doing the same thing that retail does, levering up and losing it all. This is really interesting because you'd imagine that the institutions know how to manage their risk, but the reality is they haven't managed their risk. They haven't managed their risk at all. And it's not just bringing those institutions down, it's bringing us all down with them. So just know, these big players that are bringing big money into the space are all bringing massive risk profile, because when they lever up and act foolishly, it can lead to forced selling that literally ruins the entire market. And this leads us to our third reason, which isn't just institutionalization, but it's leverage and bad risk management. We've been hinting at these two the entire time. And this is the part of crypto that honestly really needs some thorough inspection. Because this time it's not just people on Bybit or normies or irresponsible retail that are inexperienced going in and using leverage to short or long Bitcoin and getting liquidated. Yes, that does happen all the time. However, in this particular event, we're talking about the most sophisticated big wallet whales in crypto not knowing how to avoid massive 9-figure and 10-figure liquidation cascades. These aren't just small errors. These are massive generational fumbles that we need to understand how we got in this position so that we can hopefully avoid this type of scenario in the future. As the DeFi Edge says, Three Arrows Capital got into the seed rounds of some of the most prominent crypto protocols, yet they might go broke. Risk management is underrated. Don't fight the Fed. Leverage is dangerous. Now, there's a lot of wisdom in here, and we talk about this all the time of selling crypto when you're up, sell when you're up, sell when you're up. And sell when you're up doesn't mean take out a leveraged loan when you're up. Sell when you're up means take some of your crypto and convert it either into BTC and ETH, which is still down, however not down as bad as the rest of the market, or what we talk about all the time, which is using USDC, which is a one-to-one backed stablecoin that is audited and based in the United States. It is the most stable stable and reliable stablecoin in the market. That's why we always talk about USDC here on the channel. And if you had sold things into USDC and just waited, well, you would have out-traded the vast majority of the market, because apparently even the biggest institutions don't know how to sit on their hands and wait for better opportunities. Three Arrows Capital lost a ton of cash in Terra Luna. Three Arrows Capital is getting margin called and liquidated. This could cause a rippling effect on the industry. It doesn't matter if you're up 100x if you don't practice solid risk management. Again, if you're still here, even if you just sold into stables just a little bit, you would have out-traded Three Arrows Capital, Suzu, and some of the biggest institutional players in the space. Again, leverage is the root of all evil here in crypto, and these hidden pieces of leverage, with Three Arrows Capital having leveraged bets throughout the ecosystem, so that when prices come down to a certain point, they actually get liquidated and have to force sell everything. These are points of leverage that affect us all. So we should know where the leverage is, and you should also understand that using leverage is extremely, extremely risky. As Fubar says, leverage is the antithesis of stability, both at an individual and systemic level. While you can build systems that wind up and wind down most smoothly, it's a massive amplifier of cyclical behavior. Effectively, what Fubar is saying here is that the ups and downs of crypto are made much more brutal by leverage, and we don't need them to be more brutal. They're already crazy. You don't need to leverage when you have 10s, 20s, 30x's to the upside. Why would you need to add rocket fuel to that? The reality is that this cycle has shown that crypto is already wildly volatile enough, that there is no lack of opportunity to the up and downside, but using leverage is a fool's errand that is going to backfire not just on you, but on the entire industry. We're going to be covering leverage a lot over the coming days and weeks, because this is one of the most important topics in crypto. So are we at the bottom, and has enough damage been done? Is this time to start buying, knowing that it's unlikely we'll go much lower? Well, let's take a look. Over the weekend, we had Bitcoin is dead searches hit an all-time high of 100 value, and that is a good sign that people are once again extremely bearish on the market. We also had the Bitcoin Fear and Greed Index hit a 9. We see now yesterday, last week, and last month, we have extreme fear on the Bitcoin Fear and Greed Index. Again, sentiment is not the only indicator, but it is a very, very phenomenal indicator at really trying to understand where the bottom could be. But remember, it's not just crypto here. Equities are also at record oversold levels. So seeing a short or midterm bounce here would not surprise. In fact, it would be crazy if there were no bounces. There's always bounces. Remember, markets are like rubber bands. You can't stretch them too far in one direction without something breaking. And in this case, some kind of swing back is not only expected, but it would just be extremely strange. That's just how markets work. So the reality is, should you just be shorting right here, knowing that we're still in the midst of this macro Fed-fueled storm of inflation and economic slowdown? Well, the reality is that it's pretty dangerous to be shorting at these oversold levels. That's why I've never talked about shorting, even though it was the play to make starting in November. Shorting is an extremely risky game that should only be done by professional traders. But then again, it's important to realize that we still have this contagion thing happening in crypto, where we didn't know how bad Celsius was until a few weeks later after the Luna UST collapse. We didn't start hearing about Three Arrows until well after we had heard about Celsius, and the dominoes keep falling. So at what point is the violence over? Well, what we know is that forced selling usually leads to lower prices than would have been organic during a normal collapse. So all of this forced selling, while extremely concerning, will most likely lead to prices that shouldn't have normally happened. Those unnatural low prices that are going to result at the bottom of wherever this thing is going are prices that I'm extremely interested in. But it's important that you keep your eye on the prize and understand what's causing this downturn and whether those forces are out of gas yet, out of steam. And in my opinion, they're not. As Degen Trading says, I can't say too much, but you're sorely mistaken if you think that Celsius and Three Arrows Capital is the end of it. The dominoes are falling contagion. Pentoshi says, imagine how many out there are affected by contagion that we are yet to hear of. There is still potentially a lot of forced selling that causes more forced selling, plus redemptions from funds. Keep some dry powder on hand. And this is the reality. The historic Fed climate mixed with these forced selling and liquidations has caused an all-out free fall in crypto land, and we're not sure if we're at the bottom yet. What's important to realize is that we're not going to recover from this level of collapse very immediately. It's not going to be a V-shaped bottom unless the Fed completely pivots and starts flooding the economy with money, which it doesn't seem like they're going to do anytime soon. So that leaves us with the question of where are the ultimate lows and where are the buying opportunities, which we'll talk about here at the end of the episode. Now, as Root2Fi explains, waking up to 3 digits ETH and Bitcoin at 18K, again, that's where it was a day or so ago, The worst part about this is knowing how many people believe this space and never come back. I knew crypto always was a scam. Now, effectively, this is what I'm talking about, because the bottom won't reverse very quickly, because there's not going to be a huge amount of people that are confident in this market. You need confidence to drive up prices. This is more or less exactly what happened in 2018, in that crypto, especially altcoins, crashed so brutally that many people swore off the industry forever. And it took them years before confidence was reinstilled, many refusing to buy until the market was back at all-time highs. We do not want that to be what this audience experiences, because that would be wreckage leading into more wreckage. The reality is that consumer confidence loss is the damaging dish that has been served up to the crypto ecosystem over the last few weeks, and that takes a while to recover. So there's absolutely no rush that the bottom is just going to come and we'll be in up-only mode once again. So while it doesn't surprise me to see some bounce here, we are at one of the most historic levels in the history of Bitcoin, 20K BTC. This is something that people would talk about for years and years throughout the last bear market. So seeing that price level just not hold at all like a piece of tissue paper was absolutely shocking. However, a bounce around this area was to be expected, and some resistance, some support rather, would be more than expected at these levels. So the question is, where is this midterm little support, this little short-term rally? Where could it end, and where could you be expecting once again fireworks to the downside? Well, according to macro analyst Darius Dale, who's a friend of the channel, who's been on the channel and has absolutely nailed every single move here since the November Fed pivot. Honestly, if we were to listen to Darius, we would be much richer people in this world. But at that point, using macro analysis within crypto was far from proven. However, we're learning not to fight the Fed day by day. However, Darius Dale said the next big shoe to drop could be an earnings season recession, which will likely be priced in by markets in July and August. Q2 earnings season starts in 2 to 3 weeks. As Darius Dale says, that is a risk. The more relevant risk, in his opinion, is the risk that we have not yet priced in the full extent of the growth slowdown. That shoe to drop is still ahead of us. As Callum Thomas says, still seeing no deleveraging, no rotation out of equities, no capitulation in equity lows, but sentiment is about as bad as it gets. So what Callum is saying is that the reality of retail investing in equities is that it doesn't reflect true bear market or recession levels yet, despite sentiment being the worst it's ever been. Retail are continuing to buy the dip without fail, which of course is leading to the dippity dip, keeping on dipping. Now let's talk about real estate, which seems to be living in its own asset bubble, not being hit as hard by the downturn of the traditional equities markets. Now what we do know is that interest rates rising means that mortgage rates are absolutely skyrocketing. With mortgage rates having risen incredibly fast in the past few months and the middle class being, quote, squeezed by record high inflation, a real estate crisis is in the making. With real estate even being more important than stocks when it comes to the, quote, wealth effect, this is of course the effect of feeling wealthy or the perceived wealth of each individual household. A deflation of the housing bubble could have severe consequences for the whole economy and risk appetite of investors. This is, of course, if someone's looking at the value of their house, which was maybe $1 million a few years ago, seeing it being valued at maybe $2.5 million, that would make them feel a lot more wealthy, a lot more risk tolerant, as they feel that there is this tremendous amount of money backstopping their financial decisions. When, of course, the housing market comes down in some meaningful way, that has a huge detriment to their ability to take on more risk or to even feel the wealth effect. As the Kobalesi letter says, economic update, housing starts in May down 14%, mortgage rates more than double to 6.3%, U.S. consumer debt near a record 16 trillion, 72% risk of recession according to Bloomberg, housing affordability index all-time low, margin debts with higher rates, this can't end well. Alf says the people saying, quote, looking forward to a recession and a big drop in real estate prices so I can scoop it all up. Dude, if that happens, you'll be without a job and decimated 401k, mortgage rates at 6% plus. Most likely you won't be able to, quote, scoop up the real estate market. As Fubar says, crypto prices are crashing because crypto failed to provide enough value to the world. Quote, would be fascinating to hear these people explain the housing crash. Housing prices are crashing because the houses do not have enough utility. Many San Franciscans have never used a house. Sorry. Anyway, the point is here that everything's crashing. It's not related to crypto. It's not related to utility. It's not related to protocol development. This is not a crypto native issue. Nothing is wrong and nothing has changed about the value prop of Bitcoin and Ethereum. We are just seeing the dampening of people's appetite to take on risk. And most protocols in crypto are at a significant higher risk than, say, an investment in a house or buying a car, things that you know what you can use them for and you know the value of them each and every day. So where is the bottom? Is it possible that we can bottom in these conditions, and how can we estimate it? Well, we have a little bit of hopium here by overlaying the current price trajectory of this current market collapse over the 2000 dot-com bubble. And as you can see from a fractal standpoint, there are a ton of similarities between this current crash and the 2000 bubble. Of course, we're about 5% off from hitting the ultimate low that was put in by the 2000 dot-com bubble. That is assuming that we're going through a crash of equal magnitude. So while we are certainly at an extreme amount of pain, we might not be at the ultimate lows. It's also important to realize that Bitcoin has never recovered while equities are in a bear market. There's no evidence of this, so we need to see things play out before we start jumping to conclusions that Bitcoin will decouple, as we all are hoping it will to the upside. And really, it's only a matter of time before Bitcoin starts to form its own market cycle, its own market structure. So before we go to the outro, I want to make it clear. There's a cycle of good money into inflation, into economic plus government ruin that drives people back into the ultimate return of sound money. It's a sequence that's begun with the Sung dynasty in ancient China and spans human history. We've done it before and will again. So as we look to find the bottom, it's important to realize that the leverage cascade created by institutional players, by the Luna collapse, by certain key points of failure here in crypto has driven the market far lower, far faster than it should have otherwise fallen. But this is not to say that we would have avoided a bear market. No, the entire economic system is being put to the test. This is not unique to crypto. We see issues in equities. We see skyrocketing commodities prices. We see gold falling. And now we see the upcoming housing crisis, which affects the wealth of most people across the country and really across the world. That's how most people keep their wealth, is within property. So the reality is the bottom in? Well, it's hard to really say that with so much economic uncertainty still on the horizon. However, what we can say is that these forced sellers, these institutional sellers, will most likely create the most important buying opportunities at some point here in the cycle. And while I said I was going to be jumping in and buying here once Bitcoin went under 20K, the style and speed in which it went under 20K really far outstripped my expectations, which makes me feel in my heart that we are going lower. I'll be looking to snipe bids in the low teens, but of course, if the economy continues to collapse, if equities have another major leg down because of earnings season, if the housing market starts to be uncertain and starts to go into free fall, as it almost seems impossible for it not to do at this point, then it's really worth considering what could happen to crypto, which is trading in lockstep with these ecosystems. The biggest thing to remember is that things like Luna, things like Celsius, things like Three Arrows Capital, things like BlockFi and Nexo and these other centralized lenders, if they fail, those are things that dramatically impact the confidence that consumers can have in crypto products or crypto savings. The reality is that confidence doesn't just get reinstilled overnight. So it's important to realize that while the bottom is likely coming up and there will be an awesome opportunity to snipe these insane lows, it will probably be an extended period of time that we will have to accumulate at those lows as the industry licks its wounds, tries to identify what went wrong. It's also very likely that we will have some regulatory clarity, some new regulations coming into crypto that are hopefully able to bring more responsible capital into the space, enable more innovation in the space, but also make it aware where there are these huge amounts of risk for retail. For example, with UST and Luna, with Celsius and other products that have literally gone to zero. It's one thing for a product to go down in value. It's another thing for it to trap your funds and go to zero. That's a whole different kind of sting. So yes, we are probably approaching the lows of the market. However, I don't believe there's any rush to be jumping in and throwing an irresponsible amount of money at this market just yet. The reality is that the Fed is on its own trajectory, and we're learning day over day not to fight the Fed, to become students of the macro economy, and know that crypto does trade within a macro context. As always, the vision of what 2030 looks like has not changed. The world is getting much more digital. Blockchain technology will lead to a much better future for people all around the world. This crash is contagion from mainstream financial markets, as well as contagion from bad risk management from key institutions within crypto. All of these rough edges and wrinkles, I believe, will be ironed out over time. And the truth is that all of this, in my opinion, makes NFTs look amazing, which tend to hold their value against Ethereum way better than non-fungible tokens. The data is right there, that good NFT projects are still doing very well compared to Ethereum when you compare them to altcoins or fungible counterparts. Seeing DeFi lose so much credibility once again highlights that games and NFTs will be the killer apps of the blockchain ecosystem. So as markets have lost their value, as money-motivated teams leave the industry, as funding dries up, the reality is that the hardworking teams focused on things like NFTs and gaming, I still believe at some point will be proven to be the most innovative and disruptive projects in the tech world. And so that's why I remain focused even through all this madness, because the way the world is going has not changed. But this current cycle and its collapse have identified some key weaknesses within the crypto ecosystem that absolutely should be addressed to make a healthier and more stable industry of the future. As always, I hope you enjoyed this episode. We'll be doing our best to bring you the most important updates here. And to summarize, I'll be buying in the low teens for Bitcoin. I'll continue to accumulate steadily Ethereum under $1,000, and I'll continue to be extremely active and participate in the NFT and gaming ecosystems, as I believe those are the true on-ramps to a digital native future. And as I have for the last 4+ years, I believe strongly that games are the vehicle to bring crypto and NFTs and their utilities to life at scale. As always, I hope you enjoyed this episode. If you did, please smash that like button. We'll be doing our best to keep you up to date and ahead of the market throughout this entire bear market, regardless of how long it goes. We're not going anywhere, and we're excited to keep working harder throughout these incredibly trying times. As always, you can follow me on Twitter at EllioTrades, and I'll see you very soon on the next episode.